Everybody, I'd like to introduce our next Fireside Q&A here at the Planet MicroCap Showcase Vegas 2024. Hosting this Q&A is Mathieu from the Rivemont MicroCap Fund, and it is with René Goehrum from BioSyent.
Thanks, Bobby. I'm going to start just with a quick disclaimer to say that the fund I manage is a shareholder of BioSyent. René, why don't we start with your background and how you got involved with BioSyent?
Okay, Martin. We also have a disclaimer, and that is there'll likely be forward-looking statements on what I talk about, so it's the usual. Just a shot of our brands while I answer Martin's question. So my background is in fast-moving consumer goods. I started my career at Procter & Gamble, and then ran a marketing and services business providing advertising, promotion, and contract sales services to large blue-chip marketing brand organizations, including a couple of pharmaceutical companies. I came to what is now BioSyent as an investor. I invested in several rounds of private placement and eventually joined the board of directors, and then subsequently was asked to come into management with the company. And after about a year of joining management, I was asked to take over as the CEO.
Awesome. So can you give us the quick elevator pitch on what BioSyent is today?
Sure. We're a Toronto, Canada area-based growth stage specialty pharmaceutical company. We look for unique and differentiated products that are generally approved somewhere in the world and on market, that de-risk somewhat the regulatory process. We take those unique assets and assess them against either addressing an unmet need that is not handled by existing products, or providing added value to the healthcare professional or to the patient or the product consumer. We commercialize those assets through our own people, sales force, marketing organization. So our business is essentially finding these on-market or late-stage assets. We're not an R&D company. We do some development on our largest asset, which is FeraMAX, and make him come up in today's conversation. And then we commercialize those products in Canada.
Okay, so let's start with FeraMAX. This has been an amazing success for BioSyent over the last 10, 20 years. Can you share what FeraMAX is and maybe how it has evolved over the years as well?
Sure. FeraMAX is our largest asset. I'm just going to flip the screen here to a snapshot with some facts on the company. So FeraMAX is an oral iron supplement. It's been the #1 recommended oral iron supplement now for 9 years running by independent survey of healthcare professionals, so medical doctors and pharmacists across Canada. And this product is the brand is now a range of products. We've got 3 different products that address different needs or different patient groups. And essentially, for those that have had the unpleasant experience of having to take an oral iron supplement for iron deficiency or iron deficient anemia, you will have experienced a lot of gastrointestinal upset. So FeraMAX is a carbohydrate wrap around the iron that essentially allows for a more gentle digestion and absorption of the iron compared to the standard, or what was the standard product that was available in the market when we entered. We promote this product to healthcare professionals, so we call on medical doctors, generally family practice and women's health, obstetrics and gynecology. Iron generally in Canada for sure is over 80% consumed by women. So although it is not a prescription medication, it's found behind the counter in the pharmacy. It's distributed essentially in the high 90% of all pharmacies in Canada, which are about 10,500. And the product is recommended by doctors, and patients go pick it up in the pharmacy. So it's promoted like a prescription medication, but it's a non-script product. Mathieu was asking a little bit about how it's evolved. We started with one product, FeraMAX 150. We have added a couple of other products, and the other thing that we've done importantly is that we have reformulated the product about 3.5 years ago. The base, the foundation for FeraMAX was changed about 3.5 years ago and has given us a new leg up on growth. So we've got a life cycle strategy addressing different patient groups and consumer groups, and then we're promoting that to healthcare professionals and also direct to patient.
What would you say is the moat around like protecting your FeraMAX franchise?
Yeah, it's you know, it's not a marketing word that I found in a textbook, but I would call it the snowball effect. Clearly, we made number one. Now we've made number one 9 years in a row. As we have built that business, it's really been about branding and making sure that our brand is front and center. Other owners of an asset like this would get it up on plane and then just, you know, go spend and pay more attention to other assets in their portfolio. So while we have launched a number of other products into the Canadian market, we've never taken our foot off the gas on this brand. And we've got a really high trust factor amongst healthcare professionals. Somebody likes what I'm saying. We've got that momentum on the brand. Every year our scores go up. So it's really been about branding and building trust, and then innovation around products available. So we have a powdered form of iron that's really targeted at children. We have now created a chewable iron product, and if you've ever had to take oral iron or any iron supplement, you'll know that it, not surprisingly, tastes metallic. It's awful tasting. FeraMAX is good tasting. We made iron taste good. So it's efficacious, it tastes good, it's easy to take, and every year doctors trust us more and pharmacists dispense us more.
Okay, perfect. Let's move on to some of the other products in your portfolio currently. What are some of the main products that you're excited about for the next few years?
Sure. Up on the board behind me, you can see that we launched 3 new products in the last 12 months. When we put a product in the launch phase, we expect that product to be in a launch phase for up to 3 years. So one of them is FeraMAX 45, which I've spoken about. That's the chewable iron. 2 others are Gelclair, which is an oncology supportive care product for patients that are undergoing radiation therapy or chemotherapy for cancer. They get oral mucositis, mouth sores, makes it very difficult to eat and drink, talk. And so this product helps manage pain so that they can continue with their medication and continue with their daily life. We're really early days on that product, but it's unique and certainly positioned unlike any other product in that category. We also launched a new women's health product for polycystic ovary syndrome, Inofolic, late last year, in the second half of last year. This PCOS is an interesting medical condition. 1.4 million women in Canada have it. Many don't even know it. It's not always diagnosed. And we've got a product that has got a track record outside of Canada of assisting women with those symptoms, and we're promoting it now in one specific niche that'll expand over time. The last one I'll mention is Tibella, a menopause hormone therapy that we launched in 2020. It's still growing at greater than 30% a year, measured in units.
Okay. You did last year. You did 31.6 million in revenue. How much could you grow your business over time just with the current assets that you have in the portfolio?
Our assessment of our existing portfolio, without adding any new in-licensing transactions or acquisitions, would be about to double that business. So in and around the $60 million mark is our assessment of peak penetration. for the portfolio.
And how long do you think that could take? I know you don't provide guidance, but like what would be sort of your high level expectation to reach peak sales potential?
So you're going to force me to give guidance. It's a good thing I put that disclaimer up. Let's call it 5 to 6 years.
I'm sorry about that. Okay, so you look to in-license or acquire new products to add to your portfolio. What are some of the attributes that you look for when you look at these new opportunities?
So we're looking for those unique and differentiated products that solve a problem that exists or that is not being addressed by existing products on the market. So it's got to have that to start with. And then we look at what share of voice we would expect. So who is promoting in that therapeutic class? We also, we're obviously looking at whether there be any constraints on pricing. There are regulations around pricing in the Canadian market. So we have to navigate what pricing we could achieve and assess that against what our cost of goods would be. And then, we've got a target range of margin that we would like to achieve so that over time we get a good return on our investment, because typically we've started these brands from scratch and it takes years to get them up on plane and a considerable investment. So we've got an IRR hurdle and a payback hurdle that we look at as well. And this clearly a win-win situation so that we know that over time we can derive a good return on our investment and our effort.
Do you have a preference for in-licensing products that you, like BioSyent, will take to market, or acquiring products that are already on market?
I'd love to own assets forever. So that would, I suppose, if we could choose just to do one type of a deal, it would be to own the asset. In our industry, assets that are on market and have a established cash flow, that's interesting. They're fairly expensive. So we have to kind of weigh those two, the cost of being on market immediately versus building over time. And also that, we think about duration of the asset or the licensing transaction. FairMax, which we talked about, we own the brand, we own the mark, we own that asset outright. We have made some acquisitions of licensing agreements. We have not actually made an acquisition of a cash flowing asset, but we are working hard on that. So I don't, our approach is necessarily one or the other. It's got to be a mix that over time continues to allow us to grow, diversify our portfolio, and consistently generate cash.
Can you speak a little bit about the pipeline for these opportunities and maybe how that's evolved over time? Maybe talk about market conditions and things like that.
I'll just pause here for a sec. Okay, that was a short one. It's like a Morse code. So there's been, in the Canadian specialty pharma market, there's been a number of entities over the last decade that have come and gone. So the characters are somewhat different. A lot of companies have just been kind of merged into others. There was a large transaction announced a couple of weeks ago, and I think I did the math right. There were 6 entities that eventually had been rolled up into one that was then purchased by a very large Canadian pharmaceutical company. So, one would think, well, there's less competition, but it's like a game of whack-a-mole. Some of those go away and then others arrive. Our industry is attractive because there are barriers to entry. But for those that have experience in the industry and have access to capital, they can form a small business and grow that. So I would say the competition doesn't feel like it's any more or less than it has been over the last 5 years. I would have expected, based on interest rates, that maybe opportunities would have presented themselves a little bit more than we have seen. Now, we've just recently seen a little bit more action. We've been working on a few things actively on the acquisition side. So, maybe interest rates higher for longer will be something that's of benefit to us. You will have noticed over my shoulder that we've got, as of December 31st, $29 million in cash. So we're looking to deploy that productively in acquisition.
So that actually leads to my next question. The company has been profitable for 54 consecutive quarters. You're generating cash flows. So what's your capital allocation plan?
So the way we look at it is that the first dollar spent goes against our strategic plan, which is to grow revenue and diversify our portfolio. So that's the first dollar spent. If you look at our operating expense, which is predominantly selling and marketing expense, brand building expense, it's gone up by a factor of greater than 50% over the last 3 or 4 years. So we're investing our cash generation and building our brands, our portfolio, that are products that are in the market, our sales presence, our marketing capability across the board. However, despite all of that kind of investment, we've still been generating cash. We started buying back shares about 5.5 years ago. In that time, we've reduced our shares outstanding by 19% or so. And we started paying a dividend about 1.5 years ago. We increased that dividend by 12.5%. So we're doing all of those things, and we're actively working on deployment into acquisition of, I would think, assets versus companies, but if the right company was available, we would do that too.
Do you foresee a scenario where you might need to raise additional capital to do like a large transaction, or maybe talk about the size of the opportunities you're looking at?
One of the things that I ask my colleagues to be aware of is if I ever start using the word transformational, that to hit me in the head with a 2x4, because I don't believe in that. I don't think that's the way to build a business. It generally signals that there's something wrong with the model or the strategy in the first place, and I don't feel like we need to do that. So our preference would be more tuck-in type acquisition than to be transformative or very large in scale. I know that I'm not being very specific, but that gives you a sense of how we would approach that. We've got $29 million in cash. We have got access to additional debt financing. So the next, after our balance sheet, the next place we would go would be, I'll call it reasonable debt. I didn't mention, but it's on the board behind me. We have no debt today. We have access to a debt financing, and we've got a small revolver available. So we would avail ourselves of that. That would be the first 2 things that we would look at. And then if we absolutely thought that the opportunity needed our action, then we would look at equity, but that would be a far down choice number 3.
All right, perfect. I think open it up to questions, and I have a few more, but just want to see, does anybody have any questions? Okay, so the question is, you've been scaling your sales and marketing expenses at the same pace as revenue growth recently, and you expect that growth in expenses to moderate compared to revenue over time?
Yeah, we would expect, the short answer is we would expect ratios as the brands gain traction in the market, those spend ratios would moderate. That's what we've done with launch products in the past. We've just had a lot of launch activity in the last 4 years. We've restaged the FeraMAX brand. We launched FeraMAX, the new PD line. We launched FeraMAX 45, Inofolic, Gelclair, Combogesic, and Tabella, and did that all in the last 4 or so years. So as products grow in the marketplace, their revenue kind of is able to pay its way, and so we've just been managing a number of launch activities. So over time, it really will depend on how much new launch activity that we have in front of us. So I wouldn't expect that the ratio would stay exactly the way it is now. But if we're doing 60 million in sales and not working on any new growth initiatives, which that would be another reason to hit me in the head with a 2x4, that I would say that, we would be able to manage the spend there.
Anyone else? Okay. Rene, what's the biggest challenge or risk that you think BioSyent is currently facing?
I got to pick the biggest. I think it's that balance. Like partly the question that I just had, the previous question, balancing our growth initiatives with profitability, I think is one that I call that more challenge. I don't think of that as a risk per se. I also know that we're trying to look for larger asset opportunities, so assets that have a higher peak penetration revenue. So we're going to kind of strap on larger opportunities. I know that in our in-licensing funnel that we've got a couple that we're working on that would be significantly sized product opportunities for us. And then it's, how to then manage with a number of growth initiatives and then taking on larger asset opportunities and balancing that out while maintaining our discipline around operating a cash flow positive and growing profitable business.
Since we're in the U.S. And there are some U.S. investors in the room, maybe some people are curious, is it 100% a Canadian story for the long term, or do you foresee maybe expanding into the U.S. over time?
We've been presented with some opportunities to take steps into the U.S. in the past. We've not done so. We think that there's a long runway to grow our business and add value with a Canadian market focus. We do have some sales outside of Canada. We sell FeraMAX to distribution partners outside of Canada, and we are working on expanding that footprint. And we're also have a separate non-FeraMAX related initiative that would see sales to other markets outside of Canada. I would say the U.S. is never say never. It's one of my mottos, so I won't say never, but it's not in the near or midterm focus.
Does anybody else have a question? Okay, well, I'll throw in the last one then. Besides yourself, Rene, are there any other key people, maybe management or board or shareholders that have been, key on this journey at BioSyent?
Yeah, I mean, we have a stable board of directors, a good mix of people that have experience in the pharmaceutical industry, like deep experience in pharma, other more capital markets and senior operating experience. So a really stable board that we renewed about 5 years ago. Our management team is a stable group. We've been together for the most part of a decade with a couple of key additions over the last 5 years or so. So all of those are key. They come from a blend of big pharma experienced people and together with others that have come from some other industries as well. So it's a good combination, but a stable group. We're not a kind of a hot and cold, up and down. That's just not the way we run things. We like things to be smooth and stable and balanced and thinking and planning out into the future.
All right, that's awesome. I really think of BioSyent as kind of a blue chip microcap company. Like a good management team. It's been stable over time, growing, profitable. Fits a lot of my criteria at least. Last call maybe for questions if anybody has one. Yeah, Ben. Okay, so the question is, how do you determine if you're the right buyer, the right partner for the assets that you're looking to in-license or acquire?
So, one of the criteria is it should fit our business model and our area of business. That's kind of the most obvious to know whether, if we're acquiring, whether we're a good fit. I think, we're looking at assets that we can grow and brands. So if it isn't a brand story, and we have a lot of opportunities for what I'll call more commodity or lower price, lower margin businesses, those aren't right for us. We're about building brands. That's kind of the way we've done things all along. And the other thing is really just an exclusion of what would be attractive to us, and it's got to be a win-win deal. So if the partner's going to make all the margin and we're not going to make any margin on it, then we're not right for the deal. But if it is a win-win partner and they are supportive of our efforts to build brand, then it has the ability to be a really good relationship. Okay, we're done.
All right. Well, that's it. Thank you very much, everyone, for joining, and thanks, Renee, for the Q&A.